I traded Intel earnings from the stock ticker INTC. And in this video, I'm going to show you how I traded Intel earnings, what was the strategy that I used to trade Intel, and what was the result of that trade. So hopefully, if you're willing, for example, to trade earnings and that's something that you're interested in, hopefully that gives you some context on how you can actually trade some earnings and what are the results that you could expect from this type of trade. And know that I've already done a lot of videos on earnings, on theoretically how I trade them, and I explain the strategy, what are the things that I'm looking at. I'll put in the description of this video the link to one video that I made if you want to know what is the strategy that I usually go for. This video is really there to show you a practical example of a trade that I took and show you what is the result after. So first of all, why did I trade Intel earnings? So for those who don't know, earnings happen every quarter. That's when companies announce how much revenue, how much profit they made per share. And they say that every quarter. They announce it every quarter. And like a lot of companies, Intel is one of them. That's why I wanted to trade Intel earnings. There are several reasons why earnings are good opportunities in general to trade. One of the main reasons why I love to trade earnings and why a lot of people also like to trade earnings is that it's very, let's say, short-term gratification. It's a very quick trade. Usually it lasts around 24 hours, and that's what really attracted me to trade earnings in the first place. Now, granted, I trade a bit less earnings because I'd rather, manage my overall options portfolio and not focus only on short-term trades. But at least I know that at the beginning, that's what really attracted me to this type of trade. I really wanted to get the short-term gratification of an earning trade. Also, during earnings, there's a lot of implied volatility. So the implied volatility, for those who might not know, is going to be the move that we expect from a stock until a certain time. And usually, the more we expect a stock to move, the more expensive the options are going to be. That's how it works. And vice versa, if we expect very few movement from a stock, then you can expect the options to are also very cheap. Proportionally, they're going to be cheaper than, for example, a stock where there would be high implied volatility, and so the options would be very expensive. And that happens for the majority of the stocks. Usually, you're going to see the implied volatility rising up to the moment of the earning announcement. Right after the earning announcement, you're going to see option prices just collapse quite suddenly, actually. And it's very often the case, and that's something that happens over and over. I mean, I've done countless videos on earnings now. Actually, I've done 4 or 5. I'm not sure if we can say countless, but I've done 4 or 5. And that's why I love to trade earnings, because there's a lot of things that, can benefit us, and that's very short term. There's a lot of implied volatility. You can benefit from that implied volatility crush. That's how we call it. But also you benefit from the time decay as you sell options, or at least that's the way I trade options. So without waiting, let's get into it so you can see in a bit more practical way what I did. So you can see the chart for the stock Intel from the stock ticker INTC. So I'll just keep it simple because no need to go into too many details here. I just want to show you what's the theory, at least behind the trade that I took, so you can see what I did. So I sold what we call a short strangle. So a short strangle is selling a put and selling a call at the same time. So in the case of Intel, I sold the 43.5 put and I sold the 49.5 call the day before the earning announcement, literally 1 hour before the market closed. So I sold my short strangle. I sold the put and the call right before the day before the earning announcement, when the implied volatility was at its highest, meaning it's when the options are at their most expensive, because that's right before the earning announcement. And then the next day, usually at least, when the earning announcement happened, you'll see the implied volatility going down very quickly, and so option prices getting cheap very quickly too. So essentially, by selling that short strangle, by selling that 43.5 put and that 49.5 call, what I bet on is that I bet that Intel is going to stay between 43.5 and 49.5 at expiration. So the expiration that I chose for that trade was April 29th. So that was literally just 1 or 2 days after the earning announcement. So you can see that I have a very short-term trade, and it was going to be very clear very quickly if I was right or wrong on that trade. So by selling that short strangle, I collected a credit of 95 cents, which means I collected $95. And the reason why is that in each option there is 100 shares. So if, for example, you can see that you're collecting 95 cents when you're selling a short strangle, it means $95 because you have to multiply 95 cents by 100 as there are 100 shares in one option contract. So I collected $95 by selling that short strangle. I shorted those options. So ideally, I want the price of the short strangle to decrease after the earning announcement so I can buy back my short strangle at a cheaper price and make the profit as a difference. That's shorting. Exactly like when you short a stock, except that here you're shorting an option. So I shorted those options, collecting in total 95 cents of credit, or $95 as I said before. And here's what happened the next day. The next day, as we can see on the chart, the stock basically did not move as much, so it was exactly here. So the stock finished at $43.59, but the day where it happened, the moment when the market opened on the April 29th, my short strangle, because of the implied volatility crashing, option prices got very cheap all of a sudden. So the next day I was able to buy back my short strangle for 14 cents of credit. So in the end, because I had shorted my short strangle at 95 cents and bought it back at 14 cents, I made a profit of 81 cents or $81 as I said before, we multiplied by 100. So I made a profit of $81, which represents around 85% profit on the credit that I had initially collected. And that all happened in less than 24 hours. So obviously $81 is not a lot per se, but you know, if you trade earnings on a lot of different stocks and you do this consistently, you'll have losers, of course. Let's not say that there's only winners. I've had my fair share of losers in the past too, but you know, overall I found this strategy to be quite cool and quite profitable for me. At least that worked very well, even though I did not trade the last two earnings seasons, and from what I've heard, apparently they were quite bad. But at least, you know, overall it's been quite a long time that I've been doing this, except the last two earnings seasons, but I've made some good money overall using that strategy. One thing to mention is that you should really focus on trading small. That's something I always say, but the reason why I'm saying it is that you never know if, for example, Intel, that stock that because it has terrible earnings just falls by 30% overnight. Then if you're not trading small, you're really going to be hurt, because when you're selling a short strangle, if you're wrong, you're really wrong. You're really going to have big losses here. So you need to be careful and you need to be able to trade small and only focus a small amount of your capital per position. So if it happens that it is the stock that falls by 30% overnight, then you're not going to be hurt that much. Here, of course, I wasn't hurt, and let's call it, for most of the trades that I take, I'm not really hurt that bad, especially on earning trades. But you never know which stock is going to fall by, let's say, as I said, 30% overnight. So you need to be mindful about this type of things. That's why if you want to trade earnings, really make sure that you don't over allocate too much capital for this type of trade, and that you still have a lot of cash in your account proportionally to how much you're putting for that particular trade. Just want to jump into my statement in Testyworks, which is my broker, so you can see a bit, you know, exactly the trades that I've taken. If you look closely here at those two lines that I'm highlighting right now, you can see that I had sold one put and one call at the 43.5 put, collecting 49 cents of credit for the put, and selling the 49.5 call, collecting 46 cents of credit. So in total, 95 cents of credit. That's what I had said before. The interesting thing is that I had sold them quite late in the day. So you can see it's 5:45 p.m. around there, because I'm living in Europe. So that's why for me, the stock market closes at 9 p.m. because I'm living in the UK. And you can see that the next day, so the stock market opens here at 2:30 p.m. So literally the minute the stock market opened, I placed those two orders where I bought back my short strangle for 14 cents of credit overall. So you can see that I bought back the put, the 49.5 call. Let me actually highlight it, for 3 cents of credit, when I had initially sold it for 46 cents of credit. So imagine that you're shorting something for $46 and then you're buying it back for $3. So you're making $43 of profit. That's exactly what I did on this call. And then I did the same on the put side also. I had initially sold my put for 49 cents of credit, and now I'm buying it back literally the next day, the same minute the market opens, for 11 cents of credit. Hence why I made in total $81 of profit is that I have shorted the put and the call the day before and the day after for reasons because of the time decay, also the implied volatility crash, and because the stock hadn't moved that much. My put and my call became almost worthless, which allowed me to buy them back and make a profit on that trade. I hope that was insightful to see how I traded earnings on Intel and what's usually the type of strategy that I go for, what's usually the type of trade that I like to place, and it's really, really a typical trade that I did here, so that was a good example. Luckily it went well, but don't forget that there can also be some losing trades. I'm not usually the type, now you must know me enough, that I'm not usually the type of people that is going to say that there's only winning trades in life. That's not true at all actually. There's a lot of losing trades. I've had my fair share, so always be mindful about your size, your trading size, and don't over allocate too much capital to single positions. That's honestly the best thing you can do for yourself. And yeah, I mean, if you have any question, if you have any comment, don't hesitate to put it down below. It's always, a pleasure to answer any question or just discuss with you in general. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.